In this video, we'll look at how to simply trade the supply and demand zones. We'll also consider very important things that you have to take note of when you are trading this Forex strategy. Then we'll look at a sell side example and a buy side example. Now, what are supply zones? Supply zones are areas of the chart where large volumes of sell orders can be found. At supply zones, we sell. So we sell at supply zones. You can simply refer to them as mountain peak zones. Yes, so that is a picture of a mountain peak right there. Now, how do you identify a supply zone? Now, we have this rally up making up this peak right here, right? So this is a recent peak, and then you identify the highest wick on the peak. So in this case, this black candle right here becomes the highest wick on the peak. And then you also have to identify the open of the last bullish candle. So among the rally down, all right, so this is the last bullish candle that was printed before the rally downwards. Okay, so you denote this point as well. So the point between the open of the last bullish candle right here and the highest wick on the peak becomes the supply zone. So it becomes your sell area. Anytime price action comes back into this area, it is a very good moment for you to sell. So you can see the rally down when I enter this area. Now for demand zones as well, demand zones are areas of the chart where large volumes of buy orders can be found. Now at demand zones, they are very good zones for you to buy. So we buy at demand zones. You can simply call them the base of an ice cream cone. All right, so you can have the ice cream here. So this is the base or the bottom part of the ice cream cone, which can be likened to a demand zone. Nice. Now, how do you identify a demand zone? So we can see clearly the base of the ice cream cone right here, right? So this is a base. This is a recent base, as you can see right here. And then this is the lowest wick on the base. So you pick your ray tool and then you denote the lowest wick at the base here. So that is this point. And then you choose the open of the last bearish candle as well. So which one is the last bearish candle? So this one right here is the last bearish candle. So open is this point. So between this point, the open of the last bearish candle and the lowest wick on the base becomes your demand zone. Okay, so this entire area becomes your demand zone. Anytime price action comes back into this area, it is a very good time for you to buy upwards. Now pay attention to this part because it's very important. Use daily time frame to find supply zone peaks and demand zone bottoms. Now the reason is very simple. The reason is that the daily time frame is a very solid and strong time frame. Anything that prints on the daily time frame is sure to hold compared to the 4-hour time frame or the 1-hour time frame that prints a lot of noise. So make sure that you use the daily time frame in identifying your supply zones and your demand zones. And the second thing is that the best zones have 2 or more daily candlestick formations. I'm referring to the candlesticks that leads up in the formation of either the demand zone or the supply zone. So this picture right here is a formation of a demand zone. So you can see the ice cream cone like figure right here. So let's look at the candles that leads up in the formation of the demand zone. So you can count the candles. So 1, 2, 3, 4, 5 on the left side, and then 1, 2, 3, 4, 5, 6, 7 on the right side. So it should tell you that the candles are more than 2 on the left side, and you can also clearly see that they are more than 2 on the right side. So that is what I'm referring to. Make sure that the candles are more than 2 in the formation of either a supply zone or a demand zone. Now, another point that I want you to pay attention to is that use the 4-hour and the 1 hour for entry. So after you have identified the demand zone or the supply zone with the daily time frame, make sure that you use the 4 hour and the 1 hour for entry. You can't trade on the daily time frame. It's not possible. So the last thing that I want you to consider is that use 50 to 70 pip stop loss when you are trading. Now the reason is that this strategy tends to retrace a lot. There will be a lot of retracement, so a large stop loss will cater for any retracements that happen. If the stop loss is too much for you, you can simply lower your lot size when you are trading. Now let's look at a sell side example. All right, so we are on the EURUSD daily time frame right here. So you can see a rally up of more than 2 candles and then a rally down of more than 2 candles, making up this peak right here. All right, so how do you identify our supply zone? So on the peak right here, you can see that we have to identify our highest wick on the peak. So it's the black one right there. We also have to identify the last bullish candle on the peak. So this is the last bullish candle on the peak. Now when you identify the last bullish candle, you'll find the open of the candle. So this is the open of the candle right here. So you put your horizontal ray tool on that one also. So you can clearly see that we have formed our supply zone right here. So you pick up your rectangle and then you denote it nicely like that. You stretch it to the right side. Right, so this is your supply zone. Anything that enters right again is a very good opportunity for you to sell. All right, so we have to trade this. We can't trade on the daily time frame. So what do you have to do? You have to go to the 4 hour time frame. So let's go to the 4 hour time frame. All right, so this is the 4 hour time frame, and then let's wait for price action to do its thing. All right. So you have to wait and wait. Trading is about patience. So more bullish momentum forming up. All right, so it enters right there. Great. But you can see that this candle is a bearish candle, but it is not convincing enough. It is not bearish engulfing, so ignore it. All right, so let's wait for a proper confirmation. All right, so you can see right there, you can see an evening star formation right there. All right, so this is a very good confirmation to sell. Okay, so what you then do is to pick up your short position tool. Right at this point, your stop loss should be between 50-70 pips. All right, just above this level right here, and then you target this portion as your take profit region. Okay, all right, so let's see what happens next. Okay, it nearly took us out, but it didn't. Okay, so that is why I advocate that you choose a very wide stop. Exactly, so we hit our take profits at this very region right here. All right, so you have to stay disciplined in taking this kind of trade. I hope you get the concept. Now let's look at a buy side example. So you can see the base of the ice cream cone, which has been formed nicely here, which is a very good potential demand zone, looking at the number of candles involved on both sides. All right, so let us draw a demand zone. So first you pick up your ray to the lowest wick right here, you put it there. All right, and then we look for the last bearish candle. In this case, the last bearish candle, which is the black one here. Where is the open? So this is the open right here. You pick up your ray tool, you put it at open. So this space becomes your demand zone. So let us pick our rectangle and shade the region. Stretch it to the right side. All right, so we have just there. All right, so this is our demand zone. Now I told you that we cannot trade on the daily time frame, so let us go to the 4 hour time frame and allow price action to do its thing. So let's see what happens. All that we are waiting for is for price action to enter the zone. Look for a very exactly. So we have that. So price action has entered the zone, and we can see a very clear bullish engulfing right there. All right. So we pick up our long position tool just right here. We target this very point. Okay, this very point right here. That will be our take profit. And for our stop loss, we target just below this region. Okay, it should be 50 to 70, as I told you earlier on. So let's allow the trade to play out and let's see what happens. All right, it's going up, it's going up, it's going up. We're almost there. We are in profits. We're almost there. All right, so just right here. So just that. So you can see that our take profit has been smashed. If you look at the number of pips involved, let me see, that is around 129 pips. You put 5 standard lots on this, and then it's making you around close to $7,000. Right? Sure. So this is a very good strategy for you to trade. I hope you understand the concept. I believe that we have understood the concept of bank trading using supply and demand. I believe that the explanations were very clear enough for you to understand. Don't forget to subscribe so that I can break down much complex Forex theories and strategies for you to understand. Thank you. I'll see you another time.